How exactly does a massive beat of 172,000 new jobs manage to trigger the worst technology sell-off since 2025? Hello everyone, welcome back to AI Market News. Today, we are breaking down a cascading market shock that began over in the US labor market and is currently sending shockwaves directly into our Japanese equities. Based on available data, Friday's May non-farm payrolls report came in at a staggering 172,000 new jobs, which literally more than doubles the market consensus of around 80,000. This stands as the strongest monthly print we've seen in months, with unemployment holding steady at 4.3% and hourly earnings rising 0.3% month over month. Now, there is a fascinating footnote to this data. Several economists flagged that some of this upside in leisure and hospitality hiring was likely tied to preparations for the upcoming FIFA World Cup kicking off in the United States. But we have to ask, why would such undeniably strong employment numbers be bad for the market? Well, simply put, a remarkably healthy labor market gives the central bank a lot less reason to cut interest rates. When rates stay high, borrowing remains expensive, which slows down corporate growth and quickly cools overall investor enthusiasm across all risk-on assets. Section 1. AI trade hit hard. Let's look at the immediate and severe local impact on U.S. markets, focusing on the heavy damage sustained across the technology sector. As we can see in the chart, the Nasdaq shed 4.18% in a single session. This marks its absolute worst single-day loss since the tariff shock of April 2025. The broader market really felt the pain as well, with the S&P 500 dropping 2.64%, effectively ending a 10-week winning streak, while the Dow also fell by 1.35%. This wasn't merely a brief intraday dip either. It was a sustained, heavy volume sell-off from the opening bell all the way through to the close. The sudden rout was particularly brutal in the semiconductor sector. The sector had already been weakening earlier in the week following disappointing earnings guidance from Broadcom, but Friday turned a standard correction into a full-blown rout. We saw massive single-day drops across major players, with Nvidia falling roughly 6%, AMD dropping over 11%, and Micron losing more than 12%. When the absolute leaders of the artificial intelligence rally face this much downward pressure, it naturally sends a pretty chilling signal to the rest of the market. To understand exactly why these specific stocks fell so sharply, we need to look at a mechanism known as the valuation squeeze. Essentially, higher Treasury yields make the expected future earnings of expensive growth stocks less valuable today. Because AI and semiconductor companies are priced based on massive future growth expectations, rate hike fears instantly crush these high multiple names when interest rates rise. In short, the higher the risk-free rate goes, the harder it becomes to justify paying a massive premium for future innovation.
Section 2. Impact on the yen. Now let's pivot the narrative to the ripple effect crossing the Pacific, examining how these U.S. data points fundamentally alter the macroeconomic landscape for Japanese currency and local equities. The graph shows the direct correlation between U.S. bond markets and our currency. Following the strong jobs print, the U.S. 10-year Treasury yield jumped to 4.55%, hitting its highest level since late May. As all of us can observe here, this immense upward pressure on U.S. yields directly pushes the USD/JPY, dollar-yen, higher, weakening the yen against the dollar as capital constantly searches for better returns abroad. The mechanism at play here is straightforward. A strong U.S. jobs report means the Federal Reserve, Lemponjambisedo, is highly likely to hold interest rates at their current elevated levels of 3.50% to 3.75%. This maintains the wide interest rate gap between the United States and Japan, which naturally weakens the yen as global capital continues to flow toward higher-yielding U.S. assets. For domestic importers and our overall cost of living, this sustained weakness absolutely presents an ongoing structural challenge. Section 3. Bringing it home to Japan. Let's shift our focus entirely to what this macroeconomic shift means for all of us managing local portfolios right here in Japan. As we can see in the chart, the tech-heavy weakness in the United States spills directly over to our markets. The sharp decline in U.S. chipmakers puts immediate and heavy downward pressure on the Nikkei. It particularly drags down our domestic semiconductor and technology manufacturing components that so closely track their American counterparts. It is a stark reminder of just how interconnected our global tech supply chain truly is. Section 4. The SpaceX liquidity drain. Beyond the jobs data, we must also introduce the major wildcard event of the week, one that threatens to add even more volatility to this already delicate market setup. We are looking at a historic event, SpaceX's initial public offering. The company has set a fixed price of $135 per share, targeting an enormous $75 billion capital raise at a $1.77 trillion valuation. This would actually surpass Saudi Aramco to become the largest IPO in history. We have to contrast this massive capital raise against the broader market's current state of extreme hedging and fear, perfectly illustrated by Wall Street's fear gauge, the VIX, surging 34% in a single session. Taking this much money out of the room at such a vulnerable moment is a serious concern for all of us.
For those newer to market dynamics, this creates what we call a siphoning effect. A mega IPO of this unprecedented scale forces large institutional and retail investors to sell off their existing tech positions, simply to raise the cash needed to buy the new shares. This effectively siphons liquidity away from the rest of the market, adding further downward pressure on existing tech stocks during an already volatile week. There is only so much capital to go around, and when a giant enters the room, other assets must be sold to make space.
Section 5. Week Ahead Economic Calendar. Looking forward, it is vital that we review the critical upcoming economic indicators so all of us can properly plan our portfolios for the volatile days ahead.
Here is the critical schedule mapped out in Japan Standard Time. On Wednesday night, we have the U.S. Consumer Price Index release, which stands as the most market-moving data point to watch this week. Headline year-over-year CPI is expected to be around 4.2%. This is followed by the U.S. Producer Price Index on Thursday night. Finally, the highly anticipated SpaceX listing begins trading on the Nasdaq on Friday night. These three events back-to-back will undoubtedly set the tone for the remainder of the month. This leaves us with a core question for the week. Does inflation confirm the central bank's hawkish pivots, or does it cool enough to let risk assets breathe? According to current market information, if the CPI data comes in soft, it could spark a significant relief rally for the heavily beaten down AI and semiconductor stocks that may have overshot to the downside on Friday. Conversely, a hot print could absolutely cement the fears that sparked the initial rout. As we brace for Wednesday's CPI print and the historic SpaceX listing, we are left with one final thought. Are we merely witnessing a temporary liquidity squeeze, or is this the beginning of a much deeper reset for global AI valuations? Thanks for watching. Please subscribe and hit the like button. This video was automatically generated by NotebookLM AI. AI-generated content may include errors. This video does not constitute investment advice. For full details, please check the description below.